Can you imagine taking out a mortgage and still be paying for it when you re a grandparent? I'm not talking about a 20 or 30-year loan. I'm talking about a 50-year mortgage. This isn't some far-off financial fantasy. It's a very real, very controversial idea being floated in the US right now. On the surface, it's being sold as the ultimate solution for affordability, a way to get millions of aspiring homeowners into the market. But when you peel back the layers, you start to see that this lifeline might actually be a financial trap, designed to benefit the powerful, not the people. Today, we're going deep into the 50-year mortgage proposal. We'll break down who's really pushing for it, what it would mean for your wallet, and why this could fundamentally change the American dream of homeownership forever. Is it a helping hand or a hidden shackle? Let's find out! The pitch is simple and incredibly seductive. Housing prices are sky high, interest rates are brutal, and for many people, the dream of owning a home feels completely out of reach. So, what if we could just lower the monthly payment? That's the core promise of a 50-year mortgage. By stretching the loan term from the traditional 30 years to a staggering 50, the monthly payments would naturally decrease, making them appear much more manageable. For someone who's been saving for years, only to be constantly outbid or priced out, this sounds like a miracle. It feels like the system is finally offering a way in, a ladder to climb onto the property market. Politicians can champion it as a pro-family, pro-affordability policy. Lenders can market it as an innovative solution to a modern problem. On paper, it looks like a whim, but in finance, whenever something looks too good to be true, you have to ask one crucial question: who really benefits? Let's run the numbers, because this is where the shiny promise starts to lose its luster. Take an average home loan of, say, $400,000 at a 6% interest rate. So if the average home buyer is paying exponentially more in the long run, who is this deal actually good for? This is where we need to follow the money. The biggest cheerleaders for this idea aren't housing advocates for the poor. They are powerful financial players. Big banks, large-scale developers, and institutional investors. For them, a 50-year mortgage isn't a risk. It's a guaranteed, long-term revenue stream. Think about it from their perspective. A 30-year loan is already a fantastic low-risk investment for a bank. But a 50-year loan? That's a golden goose. It locks in customers for decades, creating a predictable, steady flow of income that spans generations. It's a financial product that outlives careers, business cycles, and even political administrations. It's the ultimate long-term bet, and the house the bank's house always wins. These institutions aren't being compassionate, they're being strategic. They see a generation desperate for housing and are offering a solution that maximizes their profits over the longest possible timeline. But the implications go far beyond just your personal finances. A widespread adoption of 50-year mortgages could have a massive and potentially damaging effect on the entire housing market. What do you think happens when you suddenly make it easier for millions of people to afford higher-priced homes? Demand explodes! But the supply of houses doesn't magically increase overnight. This surge in demand, fueled by cheaper monthly payments, would almost certainly drive home prices even higher. So the affordability problem doesn't get solved. It just gets kicked down the road with a bigger price tag. The very tool designed to make homes more accessible could end up making them more expensive for everyone. This creates a dangerous feedback loop. As prices rise, buyers need even longer loan terms to afford them, further entrenching these ultra-long mortgages into the system. Developers and sellers make a killing on the inflated prices, while buyers are saddled with even larger debts that they'll be paying off for the majority of their adult lives. And let's talk about what this does to the concept of homeownership itself. For decades, a home was seen as a primary way to build generational wealth. You work hard, you pay off your mortgage in 20 or 30 years, and you own a valuable asset outright. You can then pass it on to your children, giving them a significant financial head start. A 50-year mortgage fundamentally breaks this model. You might take out a loan in your 30s and not pay it off until you're in your 80s. By the time the loan is paid, you've spent your entire working life and your retirement sending checks to the bank. The ability to build equity is drastically slowed down. In the early decades of a 50-year loan, your payments are almost entirely interest. You're essentially renting from the bank, but you're also responsible for all the maintenance, taxes, and insurance. The home stops being an asset you build for your family's future and becomes a lifelong financial obligation. It shifts the power from the individual to the institution. Now, you might be thinking, what's the alternative? People need a place to live, and the current situation is unsustainable. That's the powerful argument that the proponents of this plan will use. They'll frame it as a necessary evil, the only way to solve the crisis, but this is a classic case of treating the symptom, not the disease. The real problem isn't that loan terms are too short. It's that housing has become wildly disconnected from average incomes. The real solutions are harder and more complex. The 50-year mortgage is a shortcut. It is a financial gimmick that papers over the real problem while creating a whole new set of long-term risks. It gives the illusion of progress without actually fixing anything. The most dangerous part of this proposal is how it preys on desperation. When you've been rejected for loan after loan, when you've watched your dream of owning a home slip away, an offer that finally says yes is incredibly tempting. It's easy to focus on the immediate relief of a lower monthly payment and ignore the long-term consequences. This is what the creators of these financial products count on. They understand human psychology. They know that short-term needs often outweigh long-term planning, especially when you're under financial stress. But it's our job, as informed citizens and consumers, to look past the marketing and understand the true cost. We have to see this for what it is: a generational wealth transferred from the middle class to the financial elite, disguised as an opportunity. It's a deal that asks you to trade your financial future for a slightly more affordable present. So, we've all felt the sting of rising house prices and soaring interest rates. The dream of home ownership feels like it's slipping away for so many. And right on cue, a solution appears. Stretch the loan out, lower the monthly payments, and suddenly, that dream house seems within reach. It's an appealing offer, almost like a magic wand for housing affordability. But what if this magic wand is actually a financial ball and chain? What if the real cost isn't just in dollars and cents, but in decades of your life? Let's talk about the dark side of the 50-year mortgage. The part the glossy brochures and optimistic politicians won't tell you about. This isn't just about finance. It's about your future, your freedom, and the kind of life you'll be able to live. Stick with me, because what you're about to hear might just change how you see homeownership forever. So, let's get straight to the numbers, because that's where the illusion starts to fall apart. The main selling point of a 50-year mortgage is the lower monthly payment. And yes, on the surface, that looks great. Let's imagine a $400,000 loan. Now let's peel back the layers and talk about the part nobody wants to mention: the long-term consequences. A 50-year mortgage doesn't just stretch your payments. It stretches your entire life as financial rhythm. You build equity painfully slow. Think about it. Equity is your stake in the home, the part you actually own. It's your path to building wealth. On a standard 30-year mortgage, after 10 years of consistent payments, you might own about 24% of your home. That's solid progress. You're building something. Now, let's look at the 50-year plan. After those same 10 years, how much equity do you think you've built? You own around 14%. That's not progress, that's stagnation. In the crucial first decade of homeownership, when you should be building a financial foundation, you're barely making a dent. You'll watch everyone around you on traditional loans grow their equity faster, pay down their debt faster, and gain financial freedom faster, while you're still stuck at the starting line, running in place. For the first 2 decades of a 50-year mortgage, the vast majority of your payment is just feeding the bank's interest machine. You're not paying for your house, you're just renting money. And here is something even darker to consider. A 50-year loan ties you to uncertainty for 5 decades. 5 decades. That's half a century. That's potentially 2 generations. Stop and really think about what that means. Do you know what your income will be 50 years from now? Of course not. Do you know what the interest rate climate will look like in 2074? No one does. Do you have any idea what the political or economic landscape will be? It's a complete unknown. But the bank knows one thing for certain. You'll be making payments for that entire time. You are locking yourself into a fixed financial obligation in a world that is anything but fixed. And if anything goes wrong along that 50-year journey, a job loss, a personal health crisis, a major recession, your loan becomes a ticking time bomb. It's a risk not just to you and your family, but to the entire financial system that's now built on the assumption of your uninterrupted, long-term repayment. We saw what happened in 2008 when risky loans blew up. This isn't just about personal risk either. These ultra-long loans are pushing the boundaries of what's even considered legal or safe. They directly challenge federal guidelines designed to protect consumers. After the 2008 financial crisis, rules were put in place, like the qualified mortgage rule, to ensure borrowers have the ability to repay their loans. A key part of that is making sure the loan term isn't excessively long. Most experts doubt that a 50-year mortgage would even qualify under today's consumer protection standards. So, this plan isn't just financially risky for you. It might be structurally unstable for the entire market. It relies on bending, or even breaking, the very rules that were created to prevent another catastrophic collapse. When financial products have to skirt the edges of regulations, it's a massive red flag. It tells you that the primary beneficiary isn't the consumer, but the institution creating the product. They are literally banking on a future that is so far away, the current regulations might not even apply. It's a gamble, and your financial security is the chip on the table. Then comes the generational angle, and this is where it gets truly dystopian. Imagine working your entire life, paying your mortgage diligently, and finally reaching retirement. With a 30-year loan, you'd likely own your home, free and clear, a cornerstone of your retirement security. With a 50-year loan, you could be 75 years old and still have a decade of payments left. You'd be making mortgage payments from your Social Security checks. But let's take it a step further. Imagine passing a house to your kids, but also passing the mortgage along with it. Think about that. A loan so long, it outlives your career, your retirement, and maybe even your lifespan. This isn't just a hypothetical. If you take out a 50-year loan at age 30, you'll be 80 when it's paid off. What happens if you pass away before then? Your children inherit a property that's still shackled by debt. It's not a gift, it's a burden. It's the opposite of generational wealth. It's generational debt. It fundamentally changes the promise of homeownership from a vehicle for building a family legacy to a financial curse passed down to the next generation. So if this is so bad for us, who exactly benefits? And guess who loves this idea? Big institutional investors, pension funds, Wall Street banks that manage long-term securities. It's a stable, predictable, long-term asset that they can bundle, securitize, and trade. Your 50-year commitment becomes a product on their balance sheet. And let's not forget the politicians. What better way to create the illusion of solving a housing crisis without actually addressing the root causes, like lack of supply or wage stagnation? They can claim they've made housing affordable while simultaneously creating a new class of debt, financially loyal and tied to the system for their entire lives. This isn't just a mortgage proposal, it's financial history repeating itself in slow motion. We've seen this movie before, with subprime loans and other creative financial products that promised a dream but delivered a nightmare. And this time, the grip is even tighter, because it's not designed to last for a decade. It's designed to last for a lifetime. So what does all this mean for you? Well, that depends on what stage of life you're in, but the message is loud and clear. A 50-year mortgage might offer some short-term relief, but it's a thief of long-term freedom. Let's break this down. For young people, maybe you're in your 20s or early 30s, dreaming of buying your first home. A 50-year mortgage can feel like a golden ticket, a way to finally get your foot in the door of the housing market. But let's look at the price of that ticket. You re-signing up to be in debt until you in your late 70s or even 80s. Think about that for a second. Your entire working life, and then some, will be spent paying off this one loan. What does that mean for your future? It means less flexibility, less ability to take risks, to change careers, to invest in other opportunities, or even just to retire comfortably. The dream of homeownership becomes a lifelong financial anchor. Now, what about families who are already on the property ladder? Maybe looking to upgrade or just manage their existing costs? For them, a 50-year mortgage means owning their home much, much slower. The equity builds at a glacial pace. Why does that matter? Because home equity is one of the most powerful wealth-building tools for the middle class. It's what you borrow against for your kids' education, to start a business, or to handle a medical emergency. With a 50-year mortgage, you're paying a mountain of interest while your actual ownership stake barely budges for decades. You're also taking on more risk. Over a 50-year timeline, the odds of economic downturns, job losses, or interest rate hikes go way up. You're exposed to that risk for a much longer period, making your family's financial foundation a lot less stable. So if it's not great for young people and it's risky for families, who actually wins here? Let's follow the money. For investors and the financial institutions that create these products, a 50-year mortgage is a dream come true. It's a sweet, predictable stream of payments stretching out for half a century. It's essentially a bond, a super safe, long-term asset, but it's cleverly disguised as a home loan. The banks package these loans, sell them to big investment funds, and collect fees all along the way. They get all the reward with very little of the long-term risk, which is pushed squarely onto your shoulders. It's a financial product designed for the seller, not the buyer. And what about the policymakers? The governments, who might be tempted to greenlight these kinds of loans? For them, it can look like an easy fix to a complex problem. Housing affordability is a massive political headache. Instead of tackling the root causes like building more homes, reforming restrictive zoning laws, or creating better financing options, they can roll out 50-year mortgages and claim they're helping people get into homes. It becomes a tool, a way to kick the can down the road and lock citizens into long-term financial commitments that keep the economic gears turning, at least on the surface. It looks like a solution, but it's really just a patch that creates a much bigger problem later on. Now, let's talk about the worst-case scenario. This is where it gets really scary. Imagine we're 10 or 20 years down the line. What if the economy shifts? What if interest rates, which have been historically low, start to climb back to their long-term averages? What if home values stagnate or even fall after a big run-up? People locked into these 50-year contracts who have built up very little equity will be incredibly vulnerable. They could find themselves underwater, owing more on their mortgage than their house is actually worth. This is the exact recipe for a wave of foreclosures. And those foreclosures don't just hurt the individual families who lose their homes. That's a tragedy in itself, but the impact ripples across the entire economy. A surge in foreclosures floods the market with cheap houses, which pushes down the value of everyone else's home. Banks get saddled with bad loans, which makes them less willing to lend money to anyone, strangling businesses and consumers. This is how financial crises start. They begin quietly, buried in the fine print of financial products that are marketed as innovative solutions. The 2008 crisis wasn't caused by a single event. It was fueled by years of risky mortgages being sold to people who couldn't afford them, all disguised as a way to expand homeownership. That's why this plan, this idea of a 50-year mortgage, deserves intense scrutiny. We need to be asking tougher questions. Real solutions to the housing affordability crisis don't involve stretching debt out over a lifetime. Real solutions mean tackling the core problems head-on. We need to build more homes. Period. We need to reform outdated zoning laws that make it impossible to build affordable, dense housing where people actually want to live. We need to improve financing options in a responsible way and strengthen protections for homebuyers, not weaken them. A 50-year mortgage sounds like a helping hand until you realize it might actually be a generational trap. It preys on the desperation of people who just want a place to call their own, and it locks them into a system that benefits big finance far more than it benefits them. It turns the dream of a home into a 50-year sentence of debt. If this breakdown opened your eyes to how these financial products really work, then make sure to subscribe. This channel is built for people who want to understand money, influence, and the hidden mechanics that are shaping our future. I want to hear your thoughts in the comments. Is this a real solution to the housing crisis, or is it one of the most dangerous financial moves of the decade? And please, share this video with someone you know who's thinking about buying a home, because understanding money isn't just about crunching numbers. It's about understanding power. And power is what shapes everything around us. Thanks for watching.